Now, to what is happening overseas, European Central Bank President Jean-Claude Trichet has left the door open, perhaps, for further interest rate increases to tame inflation. Well, our next guest says investors appear to be most concerned, bond investors, about the impact of emerging market inflation on developed nations. Bob Michele is Chief Investment Officer of the Global Fixed Income and Currency Group at JPMorgan Asset Management. He oversees $124 billion in assets under management. Bob, thanks so much for joining. It's great to have you in the studio. Now, we talk about emerging market inflation. I was just reading about Argentina potentially hitting a rate of inflation of 30% this year. Hard for us to grasp, but we are seeing signs of it throughout developed nations. Why is that such a concern for bond investors?
Well, today was a pretty good example of why it's a concern. The central banks are struggling with policy. They really don't know what to do. On one hand, as you point out, the ECB lifted interest rates by 25 basis points. Their headline inflation is 2.6%. On the other hand, you had the Bank of England, the MPC, leave rates unchanged, and their inflation is 5.5%. And then if you look at the Fed, there's a bit of a fist fight breaking out at the Fed with a divergence in policy opinion. There are some that want to end QE2. There are some that think that it may have to be continued. You could see QE3. So from the perspective of a bond investor, trying to understand how central banks are going to control liquidity and the money supply makes it more challenging, particularly at these yield levels.
Now, interestingly, when we're looking at just U.S. Treasuries, we're not seeing a lot of movement there in response necessarily to what's happening over in Europe. At the same time, there's an interesting article today on Bloomberg about high-yield investors actually taking funds and pushing them into leveraged loans. Now, high yield is one area that you think offers some opportunity at the moment.
Yeah, I think that's true. If you think about the level of yields and your comment that government bonds haven't really moved that much, it's a bit like a coil that's being wound tighter and tighter. And I think you are going to see some burst in here. When we look at high yield, we see a 7% yield. So it's not the 20% we could have gotten a year and a half ago, 2 years ago, but nonetheless, 7% still pretty attractive. And we think that yields can come in to 6.5%.
And Bob, we were just talking a little bit about high yield versus leveraged loans, but there are other ways to actually protect your portfolio. And there's an interesting trend in these unconstrained strategies. And maybe let's start off with leveraged loans, though. Leveraged loans are floating rate loans. And if we are seeing a shift out of just high yield into leveraged loans, that potentially is a way to protect yourself.
Yeah, I agree with that. And I think that's the one thing that most investors and plan sponsors are concerned about. They're afraid they're going to walk in one day and interest rates will be double the current level. And putting money in a portfolio of floating rate security is one way to protect yourself. Of course, in our view, you have to be more concerned about the credit spread and the credit risk than the floating rate of the instrument. You could simply put together a portfolio of corporate bonds and swap it back to LIBOR yourself.
Right.
That's tough for plan sponsors.
Which is tough for a plan sponsor. Now, let's quickly, we have about 30 seconds. Let's talk about unconstrained strategies. It sounds very fancy, but really we're talking about unindexed strategies, being able to invest as you please as a bond fund manager.
Exactly. Investors are concerned today that rates will double. They're not sure what will happen with credit spreads. Are they too narrow? Are they too wide? Are there opportunities elsewhere in the bond and currency markets? And an unconstrained portfolio gives the manager the flexibility to look around, try to identify best ideas, concentrate them in the portfolio, and not get involved in things which are difficult to sort out, like peripheral Europe.
And not have to be held accountable to a particular benchmark and its performance, which is something I'm sure is the...
Oh, no, we're held very much accountable for performance.
But you don't necessarily have to mimic that particular index.
Exactly.
All right, Bob, thank you so much for joining us. Love to have you back, giving us great insight into the fixed income markets. That was Bob Michele, Chief Investment Officer of JPMorgan Asset Management, oversees the Global Fixed Income and Currency Group there.